This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Final point, which I've listed as an unusual situation, this is probably the shortest lecture I'll ever give, is what happens if the employee has a choice as whether they should have shares or cash. Now, what do we already know? We know that if the employee is going to get shares or share options, the employer will debit profit and loss and credit equity. If you're going to give them cash, we know that the employer will debit P&L, credit liability. We've been talking about that as we've gone through this chapter. What do you do if they have the choice? Well, the logic is very similar to a convertible loan, if you remember those. In a convertible loan, you actually normally pay people money, but you can give them shares in the company if they want, and we used a form of split accounting. It's exactly the same here. So, similarly, part of the cost will go into liability and part of the cost will go to equity. You might say, well, why on earth would you have a situation where the employee gets the choice? Well, it's very unusual, but perhaps if the employee takes the shares, they're not allowed to sell them for a few years, in which case they're taking on a lot of risk with the movement in the share price. And maybe it's you can have the money next year or the shares, but you can only sell the shares in 3 years. I suppose that's when this situation might arise. Either way, it is just possible that of, say, the total cost of, say, 10, 8 is what you'd be paying the person in cash. The rest, again, would then be credited to equity, because that would be seen, again, as the element of gambling being taken on by the person who's taking this instrument on in the first place. There's a little formula to work out the equity component. Again, I wouldn't get too excited, but to sort out, again, the amount that relates to equity, you take the fair value of going down, the equity, if you like, root. That's how I think the standard expresses it. How will you work? You'll be told that, so don't panic. So if the fair value of getting shares is 10, the fair value of going down the cash route or liability route is, say, 8, then the bit that's seen as an equity component, or the bit that would be credited to equity, again, would be 2. So it's a very basic example, but using my numbers there, if that was the case and you were told those numbers and nothing else was happening, double entry would look like this. Debit P&L, 10. Credit liability, 8. Credit equity, 2. Where would you find the 10 and the 8 in the exam? They'll be given to you. Where'd you get the equity? It's a balancing figure. So the beta I've written there is balancing figure. So don't lose sleep about it, but just be aware it's split accounting. Certainly doesn't come up as often as convertible loans, but the principles are more or less the same. That's it with choice of settlement. Thank you.